G'day, Andrew here, Mortgage HQ, and I've got Greg from Devon Funds. I've listened to a couple of podcasts and interviews he's been on, so I thought I'd love to have him to chat about the economy and property market as he sees it. So welcome.
Hi, Andrew. Great to be here.
I thought it'd be good to give everyone like a little insight on Devon Funds, the history, what you guys specialize in, a little bit about your background, and we can jump into it.
Yeah, sure. So I'm actually really relatively new to Devon. I joined about 7 or 8 months ago. I was with an Australian business prior to that called Fat Profits, so very much a retail-focused business looking at stock market research, managing a bit of money. I knew quite a few of the guys at Devon, so I have come here for a new challenge. Sounds a bit of a cliche, but that's the reality. Look, Devon have been around for over a decade. They manage money for all sorts. So for the New Zealand Super Fund, ACC, community trusts, wholesale investors, institutions, KiwiSaver, as well as mum and dad and retail investors. So over $2 billion. So yeah, they've got very much, Devon's very much a value orientated manager, not a deep value, but value orientated. And I suppose when I joined, one thing I looked at was this transition. If you're looking at the stock markets, from a period where interest rates are very low.
Yeah.
And like growth stocks are all the rage, and we've obviously had things like Tesla and Netflix and big growth companies do really, really well, to a phase where maybe this is sort of what we're talking about, I suppose, where interest rates are starting to head up. And from a stock market point of view, that the bar of valuation sort of raises a bit. And so companies that maybe are a bit more boring and have closer dated cash flows come into favour a bit more. We're obviously seeing everything sort of sell at the moment. So that was what I liked. So yeah, very much a value orientated manager. Quite a big ESG tilt as well, and just looking to sort of buy not so much unloved companies, but just looking to buy companies with good growth prospects, but at a reasonable price. And that you've seen that transition from growth to value, and a lot of the Devon funds, if you look at the last sort of 6-12 months, even a couple of years, have started to outperform quite nicely. And even this latest bout of volatility, the funds have actually held up pretty well.
Nice. It's I'm sure you guys talk about it every day. Just try not to look at the numbers for the week, but it's hard. I saw anecdotally, I was reading some of Howard Marks stuff. I thought, hey, now's a good time to go back and look at some of the Oak Tree stuff, and I saw a lot of those big names. They went up 88%, but then they went down 88%, and then they actually $100 from 2 years ago of those shares is actually $40 or $80 or $90 today. So there's been huge runs, but there's also been big drops. And
that's absurd. You've had a lot of these sort of pandemic beneficiaries, in that technology camp. Everyone's staying at home and everyone watching Netflix or jumping online or doing whatever. And these companies have really benefited, but it's just really shot the valuations up. So they've had a lot further to fall. And some of it's been incredible. I was looking at a couple of these buy now, pay later names, in Australia yesterday, and that's been all the rage, isn't it? You've been able to sort of tap and go and spread your payments over a few weeks. There's a couple here that fallen 90% this year. It's pretty incredible stuff.
I saw that. I think it was Twitter that they bought Afterpay for $39 billion, basically. That has been written down to a value of zero now, and that Twitter's valuation has gone to $39 billion, which is what they paid for that company in shares. It's crazy time. And I shared Nassim Taleb's Twitter quotes, some of them in our group chat the other day. One in particular saying, if you've only got into finance after 2008, then you're just cheap labor. You don't actually know. You don't know that things should be valued based on valuation metrics, not on just cash flow.
That's right. And it's been, you're quite right. And there's been a bit of a trend towards talking about valuing companies based on revenues rather than cash flows or earnings. So a lot of the traditional stuff went out the window for a while, but what's sort of coming back to the people go, earnings do actually matter.
So what I think that the insights that you're going to have that you're spending time researching is around the macro side of things in New Zealand in particular. Like a lot of our followers are probably, I'd say on average, under sort of that 35 to 45 age range, probably only been investing for maybe around 10 years. I'm really interested in how you think about the next 6 months. What are you looking at? What do you think that is scary or maybe the wave is out past the breakers, but you can see it coming.
Yeah, no, for sure. And look, there's a lot of scary stuff. Obviously, whenever the stock markets start making the front pages of newspapers and leading with it, just did an interview before actually for News Hub, whenever that starts leading the news, you know there's something serious going on, of course. And, the stock market, the New Zealand stock market has entered a bear market. You'll hear that term. So it's fallen 20%, more than 20% from the peak in October, which is coincidentally when the RBNZ started raising rates, one of the first in the world. So yeah, that's obviously distressing. People that have got KiwiSaver or people that have bought stocks recently, say in the last 6 months or 12 months, or got into stocks during the pandemic, which is obviously a lot of people have. Quite distressing. It is actually worth pointing out though that there hasn't been any place to hide. It sort of feels like that at the moment because it's not just the stock market's going down. The property market's going down. Bond prices are going down because of yields, and people think, oh well, cash is safe, but cash has actually been going down as well because you think of all the inflation we're getting, so everything, there's been no place to hide, really. Yeah, for sure. I mean, in terms of how we're looking at things over the next, 6 to 12 months, look, there's still a lot of uncertainties. It does feel like, and a lot of generation of investors, and perhaps many on this on this webinar will be not used to interest rates going up, not used to them being above 5%, not used to them inflation being, much more than a couple of percent. So that could all change, and that's not necessarily something to go, let's just panic and completely get out of the stock market altogether. But it just, as I suggested right at the start, probably just represents a slightly different phase in which, investors might need to approach a lot of things a bit differently. I think that's how we're looking at it. I think, the next sort of 6 to 12 months, there's we've got interest rates going up. We've got people with mortgages coming, something like 30 to 40% of the, and the stat better than me, but coming off their short-term rates that they got a year ago, 2.4% or whatever it might have been, coming off those rates. I think we're 30% of mortgage debt in the next sort of 6 months. So people already pay more for their grocery shop, for petrol, and now they're going to be paying more for their mortgage lending. So that has to, and obviously people are consumers, and then that obviously is a key driver of the economy. So that's not something you can sort of dismiss. I caught up with a well-known economist in the last year who said that people just cut back on cappuccinos, but I don't think that's probably going to cut it really. I think. So, the way we look at it, I think, companies with exposed to discretionary expenditure, you're going to have to be very careful about investing there. I think companies we're looking at are those with strong market positions, pricing power. If you look at the latest earnings season in the US, a lot of companies that are doing well in terms of their share price or good reactions are those where they've had pricing power. So they've had inflation, but they've been able to pass that on to consumers. It hasn't had a destructive impact. Those companies that haven't performed so well are where they haven't had that pricing power and whether they're just wearing those costs. Target is a good example in the US. Big Walmart, big retailers, they're suffering. They're able to discount retailers of their customers expect cheap products and they're not really in a position to pass it on.
There's a lot of lagging effect. I can talk from first experience. So I got a chemicals company. It's a 40-year-old company. We do commodity chemicals, but we also do stuff in supermarkets. So what has happened is the international supply has taken a lot longer than it used to, and the costs have gone up. And so what you've got is you've got operational managers that have seen delays and price increases, and they've been really busy, but they haven't passed them on to their client. So what happened is in that business, the margin is shrinking. And now the results have over the last year coming into senior management, board management, and everyone's starting to say, okay, we've had awesome couple of years with COVID, but this last year is half of what it was. So now the inflation is actually going to be coming because those costs are going to get passed on. And I've been talking to that team to say, hey, look, you've got to pass the costs on. And if you don't, we can't supply these people anymore because it's below cost.
Yeah. And that's a great point. So, I think companies can pass it on and it can maintain their top line whilst, protecting the bottom line a bit. So, and look, and before we get too gloomy, a lot of economies aren't in the worst position. We've got, inflation at multi-decade highs, but we've got unemployment at multi-decade lows. So that's not a bad starting point. Is that inflation going to come down a bit? I guess the big question is, how long's the war going to drag on for? I mean, no one knows that. Obviously, ideally it would end tomorrow, but so that's a bit of a wild card. But the economies aren't in too bad a spot. household balance sheet's actually very strong. A lot of people, obviously, people have been spending massively during the during the lockdowns and over the last couple of years, but they've actually built up quite a bit of savings as well. It hasn't all gone on TVs and the like. So I think that's the reason to have a little bit of optimism. But there's no doubt consumer wallets are gonna come under pressure. I think companies with high loads of debt, just as people with big mortgages, might be a little bit worried. Companies with high debt loads, because their costs of borrowing is going to be going up as well. So that's something we're also looking at. What debt levels have companies got? What sort of terms are they getting? How long is it fixed for? All that sort of stuff that you can apply to.
Going to be a lot of 50 to 100 mil refinances for those big corporate bankers.
Yeah.
Everybody was doing their numbers on 3-4%. Now they're going to do them on 6 or 7%.
Yeah,
and that was 12 months ago.
Well, the interesting thing, talk about mortgage rates as well. And again, this is your area, but the US, I think US mortgage rates hit, I think I'm right in saying 6.8% or something this week. They were 5.3 or 4, I think, a week ago. New Zealand mortgage rates typically are higher.
Yeah,
typically higher, historically are higher than where US rates are. So, interesting.
Yeah, I even saw Simplicity, they're doing 3.9% floating this week, and I remember them being like around 2% not long ago. And that is they're not trying to make money on it, right?
No,
they're only trying to make like a slim margin. So 3.9 being like the lowest that anyone could possibly do it is quite a bit higher than what we've been looking at. So we tried to not get too political here. Having said that, like most investors do lean more to the right than left. I think a big thing that a lot of people in New Zealand are waiting for is what's going to happen politically, because we have been polarized a lot more than in the last 2 or 3 years than we have been in probably the 10 years before that. So what happens? There's been a lot of stimulus into the economy. Who's won and who's lost? And then what happens if Labour wins and what happens if National wins?
Yeah, look, I actually don't think Labour did that bad a job in terms of getting the economy through it. I think, as it's turned out, closing the borders while there was a vaccine, and, we had Omicron, which was more benign. So that all seems to have worked out pretty well. Obviously, plenty of stimulus, but every country around the world did that, got us through to the other side. The RBNZ sort of played its part. So I think all that sort of stuff wasn't too bad. Lots of other things are probably a bit more questionable, and then we're probably getting a bit too political here in terms of delivering on promises.
There's always fringe stuff, right?
But restructuring the health sector during a pandemic, I'm not sure that anyone.
Don't take my shirt. Don't take my shirt as a sign, all right?
But anyway, so I think all that said, not too bad. But then I do look more recently, and look, there is a reasonable call for a bit of austerity. We've got through to the other side. We've had the spending splurge. That last budget, wasn't exactly full of austerity. Well, it was completely the opposite. So that's.
I was just reading a post on LinkedIn. An ACT party member had put that the communications team in transport has gone from 33 people to 85 people, and like a huge chunk of them are on 100K plus. Communications for our transport, like it's a monopoly firstly, and like what do you need to communicate about? And that's just one example of many adding to, essentially working for the government. There's been a huge increase in those people, and somebody has to pay. Yeah, that's right. So I think, look, the way things are looking at the moment, even let's set aside the recent poll results, when economies sort of turn down a bit, which looks possible, that often heralds in a change, doesn't it? And it can happen for other reasons. You look across the Tasman, Labor getting in. Scott Morrison, he was deeply unpopular, and I didn't think they did a terrible job either. So what's going to happen going forward? I suppose if Labor stays in, it's more the same, but it's going to be tough to keep spending like that and can down the road if the economy's sort of turning downwards. So I do sort of wonder about that. National comes in a bit more austerity, which seems like probably the right thing to be doing. We can't just keep spending sort of forever. And this is the thing. Obviously New Zealanders are being asked to tighten their belts. We're all getting
getting smashed at the forecourts and at the supermarkets and what have you. Yet the government's sort of not really, do as I say, not as I do. So I just wonder about that. And maybe maybe there's a few learnings from over the Tasman as well, because Labor have got in and they're actually probably not too different actually from the previous government, and they're probably closer to National. And I actually think they're probably on the right path. I think infrastructure, I think, we are going to spend. Let's spend on stuff that'll be here in 10 years, 20 years' time. It's going to benefit future generations. Spending now to get a bit of a sugar rush. I think that, that's. So I think if and when we get to the election, if Labor gets sort of kicked out, pretty comprehensively, that will probably mean the economy is not in a great place. At the moment, it doesn't feel too bad. We're talking about bear markets and inflation's pretty high and all that. So I suppose that that will be something that will swing people. National's seen as more pro-business, seen as more positive for the stock market. That said, the stock market's actually done pretty well with various governments over the last sort of 10 or 12 years.
Yeah, I think if Labor gets in, we'll definitely see a lot more taxes and penalties for investors and for your higher earners. So the first stage of that with the dropping of the interest deductibility for investment property, I think it's just stage one of maybe 10 big steps that they want to take in that area. But I have noticed that they're definitely incentivizing investors to supply properties to social housing. And I think that the state to provide would probably be the trend again. So being a mortgage-focused podcast, if National wins, I think they'll drop the rules around the interest deductibility and maybe even try and incentivize even further for investors to take action and get the transaction volume back up.
I certainly go along with that. And obviously there's a housing shortage still. We can go into how that hasn't been delivered on, but there's a certain number of homes that need to be built every year, and we need
Fletcher's board might be on the block.
we need new supply. And that goes without saying. So I completely agree. And obviously, there's been efforts. Obviously, there has been an effort to clamp down on lending, and that's sort of gone too far. Probably the other way. You talk about interest deductibility as well. So for sure, I think there'd be and Kiwis generally feel happier, don't they, when the property market's sort of going in the right direction, or at least not going backwards. So, but there's a housing supply thing as well. So it'll be interesting because I think if you look at the next 6 months, it'll be interesting to see how property developments go. I mean, I think that's going to be talking to a lot of a
fun time for a lot of developers. I don't think. Sorry.
I was talking to an insolvency partner at a big firm actually a couple of days ago, and he certainly felt that would be. We're already seeing this pain, and there'll probably be more of that. In the coming months.
It's so many things interlocked that even if some developers have been doing things quite prudently, that the way that developers do it is reliant on other things, and even very astute investors seeing the delays they're seeing and seeing the cost increases is just their spreadsheets is very much at the outer edge of their expectations. And I've got a development property, it's consented for 8, and we've got to do something in the next 2 years. It definitely was our plan to develop that property this year, but we probably won't. So now we're going to spend 30-40 grand, do some nice renovations and let it sit for a while. It might sit like that for 10 years undeveloped because we get onto other things. So the supply of houses that would have been developed in a better market is definitely going to be a lot higher than it would be now because people just don't have the confidence or the deep pockets, especially when interest rates are for development, you're 6-7%, up 10, 11, 12%. So the numbers are much harder. I quite enjoyed your insights on the Taxpayer Talks podcast around ports. And I'll try and get that linked in there. I thought there was a tremendous deep dive into an example of why councils shouldn't own assets like that. And I think it's interesting to touch on, like, generally speaking, privatization and about councils getting out of running businesses. I'll be interested to hear your thoughts on that, because that directly impacts mum and dad on the street that doesn't have to pay as many rates.
Oh, absolutely. That's quite timely, isn't it? Because there's been lots of sort of mismanaged projects at the ports, since the company delisted from the stock market. And one of those is the automation project. So they basically bought this, wanted to automate the port, and effectively bought this thing out of the box and thought they could do it themselves, and been a bit of a disaster. And over the past week, they've written it off, and the estimates vary. I saw one estimate earlier today that the end cost when you wrap it all up could be like $1 billion. $1 billion. I mean, quite right. That's I'd be much keen on paying less in the way of rates, being an Auckland ratepayer. And that like Port, and look at Port of Tauranga. That was sort of partly what the article I wrote about and was in the Herald, and also the podcast. Port of Tauranga, since the Auckland Ports of Auckland delisted, Port of Tauranga's flourished. It's gone from being a smaller port with less prospects to a much bigger port with great prospects. It's nailing Ports of Auckland on a number of counts. And when you're on the stock market, and not saying that all companies do well just because on the stock market in terms of governance, but it does tend to foster better governance, better decisions. You think of Ports of Auckland, it's sort of away from the limelight. It only really comes up every time there's a mayoral cycle. Everyone just sort of forgets about it. No one really reads the reports that they put out. There's no accountability, and it's just been a bit of a disaster. And you've got, you haven't really got, business people sort of running things. You've got some industry people there. The council just sticks its hand up and says, we don't have any involvement in the day-to-day operations. So it has not been.
But give us our money.
And all sorts of decisions. Like, I think they bought like these super cranes or something, and then they went and put them on the land, and they worked out the land wasn't strong enough, and then all sorts of things like that. And the only, I guess, thing going for the port is obviously the land is valuable. It's very valuable. But if you just look at the port, the value destruction has been quite severe. So I think it was just an interesting case for a company that's gone off the bourse and is out of the limelight, has pretty much been mismanaged for a couple of decades, whereas a similar sort of business is done quite well. Look, it is a bit of a political football. And that's the other one, actually, in the budget, investing money to look at moving the port, to Manukau. There's a massive sandbar there, so you wouldn't...
It's not going to work, is it?
Wouldn't going to work. Even if you could, you probably get a lot of ship pilots that, that wouldn't even...
It's on the wrong side, right?
Yeah. And then, if you look at, New Plymouth, right, there's a lot of unusable days there, but just because of the weather on that side of the country. Insurance, even they could find insurance company to insure them. Then be a whole lot of pilots that sort of would captains should say that would not want to sort of push through there. So
the success of Tauranga has pushed the property prices in Tauranga up as well. And so a successful port has been great for that area.
That's right, and that's absolutely right. And Port of Tauranga, it's thrived on the back of the port. They're never going to sell out port in a million years. And great for the local economy. It's been well managed. They've done very well, even during the and different approaches to the pandemic. They've sort of been quite resilient, whereas the Auckland sort of stuck its hand. Safety, actually, that's the other thing. Safety has been pretty bad at Auckland as well. And that report that was commissioned, I think they've only followed through on half the recommendations or something like that. So just a good example of differences in paths on private versus, was partially listed Auckland ports, but private versus council ownership. And of course the current government's probably not going to ever want to put they're not in favour of privatising or sort of putting companies like that back on the stock market. So they want to get them off it almost. But so that's that's not going to happen. But quite an interesting case study, that one.
So where are you getting your insights, and how are you developing your ideas? You must have blogs and subscriptions and specific people that you think. I've been investing in markets for 30 years, long time, showing a few grey hairs, not bald yet, but going there. So I've always liked reading about markets and looking into markets and all sorts of. I'm a big fan of actually coming like a myriad approach. You get all this information and then you try and make sense of it and form your own view, and obviously you're bouncing off colleagues and the like. So, but there's a lot of publicly available places you can get information, and places that aren't that expensive. You can pay $40 a month and get a subscription to Bloomberg News, which is quite good, and lots of bits and pieces on there. You can get the FT, you can get Reuters, and I'm not talking about getting a Reuters machine and paying $20,000-$30,000 a year, but you can just subscribe there. There's there are some interesting blogs around, and Mark Faber's one. He's very much a sort of a perma bear, but it's also interesting to get an alternate view as well. There's a lot of interesting commentators that I pick up on, likes of CNBC. You get all the sort of like Jamie Dimon, JP Morgan. He's been all over it the last sort of few weeks. He's been talking about the economic hurricane that he sees coming, actually. So he's been quite bearish. Yeah.
doom and gloom, and you see plenty of, but that is quite good as well, because you get various CEOs on there coming out with their view, but you get all this information on any of the sites I've mentioned. Well, a lot of it's maybe focused on America. America sort of does show the way in terms of global trends. Australia, I think the AFR is a great publication actually.
I click on a lot of the AFR stuff, but I'm mostly getting it secondhand from LinkedIn or something.
Yeah, so I think that's a really good financial publication, I think, in terms of Australasia. And New Zealand, Business Desk is a good one. They put out some stuff, and MBR from sort of time to time, and obviously got the Herald Premium and so on. So in terms of good returns, I suppose is a good industry one as well.
Yeah.
Investment news, if you're starting to look at funds, there's some sort of good stuff there. But very much, and probably none of the publications I mentioned are going to necessarily be the answer, because there's lots of different opinions. So you're sort of going to work out not quite what you believe, but what makes sense. And it's sort of like a myriad sort of approach, filtering down, and hopefully some sort of answer pops out the other end.
So you're standing in one of those pods, which you are now, and there's just cash floating around. You got to catch it.
Something like that.
Time is limited. No, Devon Funds, I'm guessing, is more globally focused. You guys still do quite a bit in New Zealand, or?
We do actually. We've got so in terms of retail funds, we have got they're mainly trans-Tasman actually. So we've got a trans-Tasman fund which is sort of 60% probably now Aussie equities, because the New Zealand market's been shrinking, the stock market.
Too small.
The Aussie market's been getting bigger. You got thousands of companies over there. There's a lot more things companies to choose from, a lot more opportunities over there. And big companies as well. These are not just like $10 million companies. These are $1 billion companies that you potentially have never heard of. So it's a good sort of pond of fish over there across the Tasman, as it were. We have got a global strategy as well, which has got a heavy sustainability tilt. That's a bit more long-term focus. So taking sort of a 5 to 10 year view. Most of the Devon Trans-Tasman funds are quite active, as in passive investing. This is a good probably a point as well. Passive investing has really taken off in recent years, because the rising tides lifted all boats, and the New Zealand stock market's gone up for like 10, 11 years. So it's just been, everything's a winner almost. But I think that might, as I said right at the start, that might change going forward. And Devon's very, very much active, not passive. So taking views, and also not just necessarily investing in something and holding it for 10 years and hoping it'll just continue to go up. And I'll give you some examples. So we've been perhaps positive on fish and pike at the start of the pandemic, but started looking at hospitalisation rates falling, and vaccines coming out, and people spending less time in hospital, and sort of seeing that, and actually taking the alternate view on fish and pike and being quite negative on it. And that stock is a stock that's fallen. A2 milk, that's another example. It's been early on in the pandemic, was doing quite well, but there's been the population, it's the one child policy that they got rid of in China, hasn't really increased the birth rate over there. And meanwhile, China's been in lockdown. They've got a vaccine that doesn't work, so that's been problematic for A2. So the Devon funds have largely avoided that one, but been on companies that are a bit more. This has been an interesting one actually. You've got reopening plays. Everyone's been looking at these companies that have done well during the pandemic, the stay-at-home stocks. And now I've got a whole bunch of companies that could do well as we reopen. Of course, we've now got the recession to worry about. But we're like a good example, Sky City. So we've been all over that over the last few months, and restrictions have been removed. People actually do gamble more in a recession as well as it goes. But
I saw the stats in America since they've legalized online gambling a lot more. Like gambling in America went from 300 billion a year, I think it was, or something like that, and it's now like 7 trillion or something. So it's like the growth has been so massive since they've, and this is just in the last few years, and especially with people sitting at home, not much to do.
Yeah, no, that's it. So I think those sort of plays. Old economy stocks, can do well. I think like healthcare has done pretty well during the pandemic, but can also do well, out of the pandemic, because it's certain types of healthcare, not fish and pike is probably, a bad example, because, they did well. They went from selling 10 years worth of ventilators in 1 year, thanks to the pandemic. Whereas, so that's not so much that example, but other companies that in the health space that, like elective surgeries, have been pushed back because of the pandemic, stuff like that. So, Ramsay Healthcare, that was a good example. That's a name we've been in, largest hospital operator in Europe and whatnot. They've had a takeover approach, so that's worked out pretty well. EBOS, medical devices, Also sort of animal health care as well. People like spending money on their pets even in a recession as well.
Certainly do, yeah.
So I
Probably
think,
spend $5,000 on babysitting for my dog a year.
So I suppose our theme is, we've gone through 2 or 3 years where people might have invested in companies that, new economy or fashionable companies or, whatever's the latest trend. Remember those stocks like GameStop and the like in the US, Robinhood. But it might be, we're just thinking the next sort of few years might be more about getting back to sort of real companies that are actually, okay, even if there's a bit of a downturn or a bit of a sticky patch or, things are a little bit tougher, doesn't mean that the whole market goes down. There's still companies that can do well. Telecoms, that's a good example. People, that's quite a defensive one. 5G, I just bought a new phone. It's all 5G ready. So
not Huawei, right?
Not Huawei, not this time. No, I got the Samsung.
In the investing that I'm doing, like buying businesses, I like the Lindy effect. I like an old business because I envisage a long history ahead for
exactly. So that's quite good. It's good to invest in companies we actually know what they do as well. Like I think that sort of resonates. But end of the day, it comes back to valuation, and if whatever company is, you got to sort of look at that as an investor, as you do
with property as well.
As you do a property, And I remember, so a lot of my family's in real estate actually, property agents and the like. And I talked to the sort of head auctioneer at one of them late last year, and he said, "Oh no, things are not good." And he said, "This is all people aren't worrying about it now because it's Christmas, January." And he goes, "Yeah, it's amazing. The amount of people that came up to him and said, 'Oh, great time to buy a house.' Like, why's that? Well, you can borrow at 2.2%."
Yeah. Well, even doing the numbers when the rates were the lowest, there was a lot of properties that were like kind of barely just washing their hands. 100% interest only finance, so when it's the best time ever in terms of interest rates and it only just washes its hands, then the benefit of hindsight, then you got to be like, oh, okay. And this is some successful investors that have big portfolios in New Zealand that they've done maybe 10, 20, even 30 years ago. They were always saying, hey, 20-year principal and interest, those kinds of deals, it has to be cash flow on that, which we've been a long time away from that. Hopefully we'll go back to that. That's what it takes.
And the only caveat I might say in all this is that inflation actually could go back down. Like there's a lot of things hanging on, what happens with the war, because whatever the Reserve Bank or Fed does with interest rates, it's not going to affect the oil price. It's not going to take the oil price of 120 to 80. That's going to have zero impact. But in food, grain, having trouble getting that, or Russia's cut off. So a lot of it will depend on how quickly that inflation sort of comes down, but those non-controllable inflation bits, if the rest of it can come down, you never know. We maybe we do see a bit of a pause. I think the other key thing as well is, central banks want to hit inflation, but at the same time, they don't want a deep recession. So I think there is still that balancing act there.
We all know that governments and anybody that has lots of debt doesn't mind inflation.
Yes, that's right. Right.
So I've got a lot of debt myself. As long as I feel like I can manage the cash flow, then I'm not worried. I've seen in the 70s and 80s investors that are now billionaires, what they did in the early stages of inflation is buying properties. So I recall Sam Zell getting $4 billion of property under contract in the 70s at the beginning of a inflationary period. And he got like all these properties under contract for $1. And I know Sir Bob Jones, he got a lot of his property deals and momentum done in the early 70s and 80s during the high inflationary time. So if you're game for managing the interest expense and you're comfortable with it, then it's a really good time to invest, especially at the beginning of a very high inflationary time.
Yeah, exactly.
And stocks, they move with inflation too, don't they?
Yeah, they do. Well, do you know what? Mild inflation is positive for stock markets historically.
There we go.
Out of control inflation is not. So, in many ways, it's good that the central banks are actually acting against inflation because we don't want double-digit inflation. But historically, inflation, inflate, good for asset prices, including stock prices. So, mild controlled inflation is actually a positive. So, and that's why, curiously, depending on what happens with the Fed, if we start, sometimes you can actually get a situation where the higher than expected cash rate increases might be seen as a negative in the short term, but actually might be a positive because, as I say, there's a lot hanging on the non-controllable inflation aspects, I think.
Yeah, cool. Well, I
All right.
appreciate that, Greg. If there's anything you wanted me to add in the comments, let me know. But anywhere we should send people if they want more information about Devon, just main website or something specific?
Yeah, just definitely go to the main website. That's devonfunds.co.nz. You can also get a hold of me on gsmith@devonfunds.co.nz.
Oh,
And a bit of a plug here. There you go on the phone number 0800 944 049. Yeah, happy to answer anyone's inquiries, and hope you got some value out of the out of this cast. And yeah, thanks very much for having me.
Well, if people aren't going to buy properties, they got to allocate their money into something, right? So
diversification. It's the golden rule.
Cool. All right. Thanks, Greg.
All right. Have a great day.